$600 billion just evaporated from the U.S. banking system, and the silence from the mainstream media is deafening. I need you to listen to me very carefully because what I am about to explain is not a theory, it is not a prediction, and it is certainly not fear-mongering. It is a mathematical certainty that has already occurred on the balance sheets of the institutions holding your life savings. We are witnessing the single largest destruction of capital since 2008, but unlike the great financial crisis, this isn't happening with a bang, it's happening with a whisper. That $600 billion didn't get stolen by hackers, and it didn't get loaded onto a pallet and flown to a rogue nation. It was incinerated by the very mechanism that was supposed to keep the economy stable. The number represents the aggregate, unrealized losses that have suddenly crystallized due to the Federal Reserve's desperate maneuvering and the silent liquidity drain that kicked into overdrive last week. When you check your banking app, you see a number. You see $10,000 or $50,000 or whatever you have worked your entire life to save. You believe that money is sitting in a vault, or at least in a digital ledger backed by liquid cash. You are wrong. That money is gone. It has been loaned out to insolvent commercial real estate developers or locked into 10-year treasury bonds that are currently trading for 70 cents on the dollar. The bank is counting your deposit as an asset at face value, but the market values it at a massive loss. For the last 2 years, they have been allowed to hide this hole in their books using accounting tricks, specifically the held-to-maturity classification. But as of this month, the liquidity tide has gone out and the naked truth is exposed. This $600 billion vanish signal is the wealth transfer I have been warning you about for 18 months. It is the moment where the rubber meets the road, and the road is made of quicksand. The smart money, the hedge funds, the family offices, the sovereign wealth funds, they saw this coming. They have already moved. They aren't holding cash in regional banks. They aren't sitting in unsecured savings accounts yielding 0.01%. They have exited the theater. Meanwhile, you and millions of other retail investors are still sitting in your seats, watching the movie, completely unaware that the projector room is on fire and the managers have locked the side exits. This is not a drill. The capital destruction is real, and if you do not understand the mechanics of what just happened, you will end up paying for it with your purchasing power, your retirement, and your legacy. To understand why this is happening today, right now, in February 2026, we have to look at the trap the central banks have built for themselves. For years, we were told that inflation is transitory and that the banking system was resilient. We were lied to. The Federal Reserve raised interest rates at the fastest pace in history to fight the inflation they created. When you raise rates, the value of existing debt crashes. That is bond market 101. The banks loaded up on trillions of dollars of safe government debt when rates were near zero. Now that rates are higher, those bonds are toxic waste. They are underwater. This created a massive discrepancy between what the banks say they have and what they actually have. This brings us to the silent bank run. You might be waiting for lines around the block, like in the 1930s or scenes from It's a Wonderful Life. You won't see that. In the digital age, a bank run doesn't happen on the sidewalk. It happens in the server room. It happens in milliseconds. The smart money has realized that the yield curve is inverted and the banks are insolvent, so they are quietly pulling their deposits and moving them into money market funds or short-term treasuries. This drains the reserves from the banking system. When the reserves drop below a critical level, the bank has to sell those toxic assets to pay depositors. When they sell, they realize the loss. The $600 billion figure I led with, that is the sound of those losses becoming real. The trap is that the regulators cannot admit this. If they admit the banks are insolvent, they trigger the panic they are trying to avoid. So they gaslight you. They tell you the economy is strong. They tell you consumer confidence is up. They distract you with political circus acts and celebrity scandals while the plumbing of the financial system bursts behind the walls. Contrast the behavior of the retail investor with the institutional investor right now. Retail investors are buying the dip on tech stocks, chasing the AI bubble, and leaving their cash in Wells Fargo or Bank of America. Institutional investors are buying gold at record highs, hoarding physical commodities, and buying farmland. They are positioning themselves for the collapse of the paper system. One group is sleeping, the other is building a lifeboat. Think of it like a game of musical chairs, but instead of removing one chair at a time, they have removed 50% of the chairs while the music is still playing loud. Everyone is dancing, smiling, having a great time, but the music is about to stop. The $600 billion that just vanished is the first sign that the DJ is reaching for the pause button. When the music cuts, half the people in the room are going to realize they have nowhere to sit, and the scramble for the remaining assets will be violent, chaotic, and devastating for anyone who wasn't prepared. Let's do a deep dive into the mechanism, because I want you to be armed with the technical knowledge to explain this to your family when they tell you you're crazy. This isn't magic. It's fractional reserve banking colliding with a sovereign debt crisis. The specific mechanism at play here is the relationship between duration risk and liquidity. Banks operate on a simple model. They borrow short, your deposits, which you can take out anytime, and lend long, mortgages and 30-year bonds. This works fine when interest rates are stable, but when the Fed hiked rates from 0% to over 5% and kept them there, they broke the math. Every 1% increase in interest rates decreases the value of a long-term bond by roughly 10% to 15%. The banks are holding bonds they bought in 2020 and 2021. Those bonds are now worth 30% to 40% less. The $600 billion figure is the aggregate whole across the sector, but here's where it gets terrifying: the multiplier effect. In a fractional reserve system, every dollar of base money supports $10 or $20 of credit in the economy. When $600 billion of real capital is wiped out, it doesn't just mean the banks have less money. It means the capacity for credit in the entire global economy contracts by trillions. This is the credit crunch. Small businesses lose their lines of credit. Car loans get denied. Mortgages get called in. We have seen this movie before, but the scale is different. In 2008, the toxic assets were subprime mortgages, bad loans given to people who couldn't pay. That was a credit problem. Today, the toxic assets are U.S. Treasury bonds, the so-called risk-free asset. This is 1971 meets 2008. In 1971, Nixon closed the gold window because the U.S. didn't have enough gold to back the dollars abroad. Today, the U.S. doesn't have enough value to back the debt it has issued. The banking system is the bag holder for the government's reckless spending. The banks were forced to buy this debt, and now it is killing them. The domino effect is already starting. Look at the commercial real estate, CRE sector. Trillions in CRE loans are refinancing this year. The buildings are empty because of remote work. The loans are due. The banks holding these loans are the same ones sitting on the $600 billion bond losses. It is a pincer movement. On one side, their safe assets, bonds, are down. On the other side, their risky assets, real estate, are collapsing. They have nowhere to hide. When one mid-sized bank fails, and we are seeing the cracks form in the regional sector right now, the panic spreads instantly. Depositors don't wait to see if their bank is safe. They just pull the money. This creates a self-fulfilling prophecy that drains the remaining liquidity, forcing the Federal Reserve to print trillions to plug the hole. And that, my friends, is the end game: hyperinflation or deflationary collapse. They have to pick one. And don't think the Bank Term Funding Program, BTFP, or any other acronym the Fed invents will save you. Those programs were temporary bandages. The BTFP expired. The emergency liquidity is drying up. The Fed is currently draining the reverse repo facility, the backup tank of gas, to keep the markets moving. That tank is almost empty. When it hits zero, the friction returns, the gears grind, and the engine seizes. That is the moment the $600 billion loss becomes a system-wide cardiac arrest. So, what do? I am not here to just tell you the building is burning. I am here to show you the fire escape. The most dangerous place to be right now is in unsecured liabilities. That means bank deposits above the FDIC limit, and even those are risky given the insurance fund has less than 1% coverage of total deposits, annuities, and paper promises. You need to become your own central bank. You need to move from counterparty risk to counterparty-free assets. First, look at ONWIGS. Gold and silver. I know, I sound like a broken record, but history is the only teacher we have. Gold is the only financial asset that is not someone else's liability. When a bank fails, your gold coin doesn't vanish. It doesn't need a board of directors. It doesn't need a bailout. It is the ultimate hedge against the currency debasement that is inevitably coming to paper over these bank losses. Central banks are buying gold at the fastest pace since 1967. Do what they do, not what they say. If the Chinese central bank is dumping dollars for gold and you are holding dollars in a regional bank, you are on the wrong side of the trade. Second, consider short-term U.S. Treasuries, T-bills. But, and this is critical, you must hold them directly or in a fund that holds them directly, not via a bank deposit. T-bills are currently yielding decent returns and, unlike long-term bonds, they don't have the same duration risk. If the system crashes, the short-term bills are the cash equivalent that the big boys run to. It's a place to park liquidity while you wait for the dust to settle. Third, look at hard assets that produce value: farmland, energy production, and yes, even certain defense stocks. Why defense? Because when economies collapse, nations go to war. It is the ugly truth of geopolitics. The military-industrial complex is one of the few sectors that the government will never allow to fail. They will print money to build tanks, even if the breadlines are stretching around the block. Positioning yourself in the companies that supply the strategic necessities of the state is a defensive play. Finally, you need to get some cash out of the system. Literally. physical cash. If there is a bank holiday, a Friday afternoon where they shut the ATMs to stabilize the system, you need enough cash on hand to buy gas and groceries for a month. This isn't doomsday prepping, it's basic liquidity management. When the Greek banks shut down in 2015, people with cash in hand could buy assets for pennies on the dollar from people who were desperate for liquidity. Cash is trash in the long run, but in a liquidity crisis, cash is king. Now, I want to leave you with the hidden rule that the elites are counting on you not knowing. It's called Dodd-Frank Title II. The Orderly Liquidation Authority. You might think that if your bank fails, the government bails them out using taxpayer money. That was 2008. The laws have changed. Now they have the power of the bail-in. A bail-in means the bank doesn't get money from the government. It gets money from you. Under current law, your deposit is technically an unsecured loan to the bank. In a failure, the bank can legally convert your deposits into equity in the failing bank. They can take your money and give you worthless stock in a bankrupt company. This isn't a conspiracy theory. It is written in the legislation of the G20 nations. They have prepared the legal framework to confiscate your wealth to save the system. The $600 billion hole I talked about, they plan to fill it with your deposits. Don't panic, but do not remain passive. The window to position yourself is closing. The smart money has already left the building. The $600 billion signal has fired. The volatility is here. You need to look at your portfolio today and ask, if my bank doesn't open on Monday, do I own anything? If the answer is no, you need to move. In my next video, I'm going to expose a specific sector of the energy market that is set to explode upwards while the banking sector burns. A sector that is vital to the Great Reset agenda. You don't want to miss that.